Retail inflation has dropped to an 18-month low for the month of December, coming in at 2.1% as the vegetable and fuel prices have continued to slide. CPI inflation at 2.19% for the month of December versus 2.33% for the month of November. The continued fall in inflation levels, accompanied by a slump in factory output, may put the pressure on the RBI to announce a rate cut or perhaps even look at a change of stance in their next monetary policy meet that is due for February 5th. We have been speaking to a lot of economists on what is the prime reason behind the fall in the CPI numbers and how should the RBI be looking at it in their next monetary policy. Let's hear them out.
I would say that 2.1% is fairly good news, and I'm quite sure it's being driven more by the food prices, and the interesting part will be to see whether the non-food components have actually come down or not, because they have been fairly sticky in the 5 to 6% range for quite a few months right now. But going ahead, I think the numbers will keep moving upwards. Nothing to really create any kind of panic, but we will be moving towards the 3% mark and probably cross it. In fact, the base effect had actually waned, and in this particular month, that was the main reason why we felt that the number would go up in the month of December, but that's not happened. It'll probably happen in the next couple of months, January and February, before correcting in March.
It is absolutely as per our expectations, and I think this lowest that you have seen for so many months could be the lowest that you had seen for many more months coming together. I think going forward it is going to creep up a little bit, even if food inflation plus housing also will play a role. So overall, I think it should inch towards by the end of March. I am expecting it to go towards 3.3% from the current 2.1%.
It is safe to say that in February, based on these last two numbers of inflation, I think the MPC would want to switch from calibrated tightening to neutral, essentially bringing back the option of a rate cut sometime down the line, dependent on the data, versus a calibrated tightening stance, which has essentially ruled out any cuts, which in fact means that the future actions will be rate hikes or status quo. So I think that would be the real change. I think actual rate action may wait perhaps till April or maybe even June.